If Iran closes the Strait of Hormuz, these three U.S. oil stocks could skyrocket. By Billy Duberstein, June 24th, 2025 at 12 p.m. Geopolitical risks could rattle oil markets. With tension simmering between Israel and Iran and the U.S. military now involved following strikes on Iran's nuclear sites, a potential flashpoint looms: the Strait of Hormuz. This narrow waterway channels roughly 21% of the world's oil supply. If Iran blocks it, a global oil price shock could be imminent. While broader markets may dip on such news, certain U.S.-based oil companies could benefit from the disruption. Here are three American oil stocks that could surge if the strait is closed. 1. ConocoPhillips. Current price, NA change, 2.53%. Dividend yield, 3.4%. P/E ratio, 11.6. ConocoPhillips is one of the largest oil and gas producers in the U.S., with about 75% of its earnings stemming from North America. Its remaining operations are split between the Pacific and the EMEA region, including a modest presence in Qatar. Despite its global footprint, Conoco is heavily tied to domestic markets. If oil prices spike, the company's cash flow is poised to rise dramatically. Every $1 increase in Brent crude equals plus $65 million, $75 million in cash flow. Every $1 increase in WTI crude equals plus $140 million, $150 million in cash flow. With a strong balance sheet and minimal debt, Conoco offers investors a relatively low-risk way to gain exposure to rising oil prices in volatile times. 2. EOG Resources. Current price, NA change, 1.07%. Dividend yield, 3.3%. EOG is a pure U.S. shale player, with additional exploration in Trinidad and Tobago. Importantly, its exports do not transit the Strait of Hormuz, insulating it from disruptions in the Middle East. From 2021 to 2024, EOG doubled its dividend, boosted shareholder returns from 48% to 98% of free cash flow, maintained a debt-free balance sheet. EOG also enjoys above-average realized prices for oil and gas thanks to favorable pipeline and storage access. Should oil prices soar, EOG stands to gain outsized returns due to its efficient cost structure and low-risk profile. 3. Occidental Petroleum. Current price, $42.48, 3.35%. Market cap, $43 billion. Occidental is another top U.S. oil stock, with 84% of its production based domestically. Over half of that comes from the highly productive Permian Basin, where Occidental owns 2.9 million acres. Inventory insights: 13 years of production at less than $60 barrel. 10 years at less than $50 barrel. Many wells break even below $40 barrel. A favorite of Warren Buffett, Occidental has reduced drilling costs by 12% since 2023. However, it carries more debt than peers, primarily from its $12 billion acquisition of Crown Rock. While that adds risk, it also gives Occidental more leverage to rising oil prices. If conflict in the Middle East escalates and the Strait of Hormuz is blocked, oil prices could skyrocket. Among the potential winners, ConocoPhillips, EOG Resources, and Occidental Petroleum offer U.S.-based exposure with varying degrees of risk and upside. Want to know where top investors are putting their money right now?